Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube.
Hello everybody, welcome to today's BizNews Finance Friday webinar. With us today we've got Candice Paine and Dawn Ridler, two independent investment advisors. Welcome Dawn and Candice.
Hi there,
Thanks,
Jackie.
Jack.
So before we get started, just a reminder to start getting your questions into the question box, and perhaps Stuart, you can just check to make sure all the tech is working this morning before we have a chat to Candice and Dawn.
Thanks, Jax. Welcome, Candice and Dawn. Always good. Just quickly, on the control panel, there's a little high five option. If you can see three pretty faces and hear my voice, can you please give us a high five? And Jackie's presentation underneath. There we go, Jax. I've got a few. I haven't got enough yet to make sure that, there we go. Okay, they're coming through now, Jax. All good. And as Jax mentioned, it's very conversational, so please get those questions in nice and early to get going. But have fun, all.
Okay, thank you. Well, before we get started, I just want to introduce our guests a bit more. So this week we've got Dawn Ridler. She has written many columns for us at biznews.com, and Dawn has a background in zoology and also an MBA. And we've got Candice, and we've been chatting to Candice a lot this week about the controversial comings and goings with an exchange control circular. And Candice, sorry, I've got a spelling mistake on that slide there. It should be Paine with an E. Candice is one of my former colleagues at BizNews and very experienced in financial services. I wonder if we should start with you, Candice, and just pick up on where we are with that controversial issue involving exchange controls. And just for people who aren't familiar with that, perhaps you could just take us through briefly in a nutshell what happened with this circular and why it's caused a stir in financial services.
Okay, Jackie, so yeah, the circular has caused a huge stir. It was first promulgated by Tito Mboweni in the medium-term budget policy statement, where he kind of dropped a surprise in that, saying that inward listed ETFs and other securities would now be classified as domestic when previously they had been classified as foreign. And what his intention had been was to make it easier for offshore investors to invest in South Africa, because the classification of it sometimes hindered how they could invest. The unintended consequences and what has caused all the controversy is that that feeds through to CISCA, which is really governed by the FSCA. And CISCA governs basically your unit trusts, but also Regulation 28, medical aid funds, insurance funds. And what it meant, if you took it kind of to its natural conclusion, was that Regulation 28 had now been changed, and whereas before we were restricted to investing 30% offshore in our pension funds, it now meant that by using these inward listed ETFs, or the rand denominated ETFs that we've often spoken about on your podcasts, you could now invest 100% of that in your pension fund. And this segued very nicely with the conversation that has been happening around the country for the last sort of 18 to 24 months about people wanting to invest 100% offshore. On the back of this circular, I think the three sort of departments involved, which was the SARB, National Treasury, and the FSCA, got together, and they realized that they probably hadn't thought this through, and they needed to reconsider. So they suspended the circular. They suspended that ex-con circular, and they have invited comment from industry and the public around it. And so we are now waiting to see what they come back with. And I think that the conversation out there is that they will start re-looking at Reg 28, because we are behind other emerging markets. So if you look at places like Chile and Brazil, where they allow sort of 50% of their pension funds to be invested outside of the country, 30% isn't appropriate any longer. But there were a lot of reasons why they suspended that, and I guess we're all waiting now to hear what they come back with on the back of all the input that they're getting from the public and industry, and the discussions they're having internally as well.
Have you put any input in? Have you filed a report to them?
I have not personally filed a report, but through the various consulting clients that I have, who are more in kind, we have submitted various reports to give suggestions around what can be done. So one of the things is it's not kind of a slam dunk or a silver bullet that everybody needs to have 100% invested offshore. You know, and we can go down the sort of reasons why, but I think that brings in more risk into a portfolio. And it's not just, we can't just look at sort of voluntary RAs that people are contributing to and feel like they need more flexibility. We also need to look at the defined contribution big funds, like the government employee pension funds and various employee funds, where potentially the trustees are not abreast of the issues. And you know, everyone saying you should be invested 100% offshore suddenly becomes the thing to do. And if you think back to the early 2000s, you know, for a decade, the offshore US and UK markets went nowhere, and the rand actually appreciated by 50%. It would not have been a good idea to be 100% invested offshore then. So there are a lot of considerations to take into account when just deciding what the percentage is that needs to go offshore. So for that reason, it'll be interesting to see what they come back with and whether they move that needle at all.
Do you think that they should decide for us a maximum asset allocation? Isn't that more for the financial advisor to decide based on where the best returns are likely?
Yeah, I think, you know, in a perfect world, in a perfect country, in a country that isn't running the kind of finances that ours are running, yes, it would be wonderful for everybody to be making their own decisions. But we need to look at the kind of macro SA picture and the outflows that would happen if we suddenly changed those sort of regulations. And I'm not saying that it's right or wrong. I know there's been a lot of speculation around what the government's intentions are around these things. But I think that we do need to look at things like asset liability matching, although that has been poo-pooed. We do need to look at actually delivering to the client what they need. And that doesn't only mean 100% offshore. It really does mean diversification and trying to match with the asset that you've got, which is your pension fund, and the liability, which is your long-term need. And how do you marry those two, that the goal for the end client is they actually have the money that they need into retirement.
Thank you, Candice. Before we start taking questions, Dawn, would you like to tell us what your thoughts are on this whole tussle going on?
You know, I think, you know, everything, I agree with everything that Candice says, you know, especially when it comes to retirement funds, you need to be more prudent. And one, not everybody can afford a financial advisor who is au fait with offshore and onshore investing and has access to well-priced offshore investments that they can put in a client's portfolio to start with. But the other thing is that I think it's a lot to do with the sort of this very funny year that we've been living in, is that there are certain providers and product providers and that kind of thing who've actually been feeding into the underlying fear that has been running right through the country in terms of you know, especially when the rand dollar went to 18, 19 and this kind of thing, you know, that produced a huge amount of fear that we were going to become a banana republic and all those other things, and that we need to get all our money offshore because we were going to closely follow them. We were all going to become refugees and this kind of thing. And, you know, it opens up opportunities for perhaps product providers who provide offshore investments that they'd really like South African money to be flowing into. But you know, I've been saying, and I've been getting a lot of queries from clients. I need to take all my money offshore. I need to take all my money offshore. We say, hang on, you just take a step back, and you know, to try and generalize it a little bit. You know, my thing is that let's sort out your pension here, sort out what money you need here, make sure it's prudently invested and is going to last the whole of your life. And you know, you can term it in various ways, and mostly what we say is that's your income block. You know, that is the block of your investments that is dedicated for the rest of your life, even if you live into 105, into producing you this income. Anything over and above that is excess, and you can do what you like with it. You can take it 100% offshore, you can take whatever risk is, but you have secured your income that you need for the rest of your life, and you can't touch that. And it depends on how big that is. And you know, so the first question is always in, you know, dealing with retirees, and that's where we're talking about at the moment. You know, regulation 28 and that kind of thing is all, you know, around retiring and retirees, is how much do you need and how much have you got, right? And from that you can determine what the excess is, and say, okay, right, you know, you can't put your whole 4 million offshore because you're not going to get any yield out of it, so you can't do any sort of needs matching. But your excess is 500,000. So let's take that 500,000, and then we'll talk about that separately to what your income block is. But you know, what people, you know, once you invest overseas, and really investing overseas is really only in equity at the moment. You're not getting any yield from anything. There's no point in going into bonds and that. Yes, you can put a bit of Bitcoin and gold and commodities in there, but essentially but that's high risk. And then you add another element of risk, which is the exchange rate, right? So, you know, it isn't just high risk, it's highly risky. So you've got to be, you know, you've got to know that you could lose a chunk of it, you could lose half of it, and it doesn't matter.
Just playing devil's advocate, if you look at Zimbabwe, people were forced to keep their pensions in Zimbabwe, and that proved to be very risky because they're basically worthless. Isn't that what we need to guard against, Dawn?
Well, you know, the thing is that then you have to sort of make the decision, you know, are we going to go the Zimbabwe route? And, you know, you know, but maybe not everybody knows, is that I've lived all over Africa. I've lived in Kenya, Uganda, Rwanda, Burundi, Zaire, Madagascar, Mozambique. I have a dual passport, but I also could get a Kenyan passport, an Indian passport, a Pakistani passport. I've got options,
Wow.
right? Right, yeah, you know, sort of diverse colonial background, I think is what they call it. But, you know, but I'm still here. And you know, we've got a critical mass in terms of industry and, you know, people that are employed and in world-class industries and investments and that kind of thing, that we're unlikely to go the Zimbabwe route. And we're also, despite the fact that we're only half a percentage point in terms of global GDP, you know, we're minuscule. We punch above our weight in terms of the kind of focus that we're under, you know, and it's still part, I think, of the Mandela halo, although that's been maybe somewhat tarnished. But even as recently as a couple of weeks ago, Mike Pompeo, who, I mean, he's an idiot, but never mind, did say, you know, South Africa, we're watching you in terms of property rights, for example, you know, so whereas they, you know, may not care too much about what any other, frankly, maybe with the exception of Nigeria, does in Africa. They do watch us, and you know, so they're unlikely to, I think, let us get into that sort of Zimbabwe situation. That look, that I mean, having lived in Kenya, I mean, I was looking at the exchange rate, for example, in Kenya. Now, when I was last in Kenya, which is far too long ago, and I'm about to remedy that, but it was about 10 shillings to a rand, and now the rand, and you know, so it was 1 rand 10 shillings, and it was the same to the dollar. It was about 10 to $1. Kenya is still 10 shillings to the dollar, but we're not you know, at that level. You know, we've depreciated a good 50% worse than that. So how have Kenya got it right and we've not got it right? And you know, so I think Zimbabwe is an outlier in terms of going to hell in a handbasket kind of thing, you know. And I think that was specifically obviously caused by Mugabe and that acquisition without compensation route that he went on, which just kind of completely decimated the country, which is why I think that's the one sort of political change that we need to really guard against and write petitions and whatever else it is that, you know, if as soon as you start eroding property rights, then you're really, really in trouble.
Thank you, Dawn. Before we start taking the questions, Candice, there has been a lot of talk from people about immigrating this year. What are the major questions that have been asked of you in your practice? What are the big questions this year from your clients, and where have you seen them making mistakes or being surprised in the COVID-19 era?
So a lot of them are obviously talking about immigrating, and what we need to do is try and plan for that in a systematic way, you know, because many of them are sitting with assets in pension funds. So put that aside, the ones who are not talking about immigrating yet are obviously asking the question, do I continue contributing to my pension fund, given the question that Dawn's just answered, you know, around Zimbabwe or you know, any other decline that we see in the country. And whether they take the you know, they put aside the beneficial tax regime that pensions funds have and they start saving, not necessarily offshore, but just having more flexibility around where they save with their savings in South Africa. So we're having a lot of those discussions. For sort of older clients who can, the ones 55 and above, we're having the discussions around whether they mature their RAs, preservation funds, pension funds, into living annuities, because living annuities surprisingly have no restrictions on where you can invest. And I need to raise this as an anomaly. So if you're a 30-year-old starting to save for retirement under Reg 28, you are limited as to the amount of risk you can take on, i.e. how much you can invest offshore. But the minute you turn 55, when actually you probably should be de-risking a bit and really focusing on this asset liability matching thing, you're now allowed to invest wherever you want because living annuities have no restrictions. So we're having a lot of those conversations and obviously trying to rein people back, which is what Dawn and I are saying, that, you know, the investing offshore is not a panacea for a badly planned retirement. You really need to start looking at what somebody has. So there's lots of those conversations. Then I think people have inadvertently had a bit of a dry run for a badly planned retirement where they've either lost their income or their jobs, and suddenly that tap's been turned off. And they're getting a first-hand view of what it feels like to have a finite pool to live on and there's nothing coming in. And I think that has actually been a terrible, you know, a very hard lesson, but a good lesson, because now we can really start having a real conversation about retirement and saving for retirement and what that actually looks like, you know, and how hard it is to earn money and how much you need to focus on preserving it. So there've been a lot of those conversations also around emergency funds. Surprisingly enough, in my practice, people who have had emergency funds, trying to convince them that this is the rainy day we were saving for, you know, because people kind of look at their portfolio and go, I don't want to touch it. It was like, well, you have to. This is, you know, it doesn't get more wet than this. This is the rainy day. So it's been those kind of conversations with clients and really hand-holding through making those decisions. So a lot of them intrinsically have the answers and know them. They just need someone to kind of go for it, you know, like, you know, spend the emergency fund, or let's look at retirement. So interesting conversations, I must say, on the whole.
Dawn, how have you helped people who've been in real financial trouble? How have they extricated from long-term savings, or what were your sort of emergency steps?
You know, most of my clients are already in retirement, so, you know, thank goodness for that. So the ones that are sort of coming into retirement, I had a couple of people pushed into early retirement, you know, because it's from a company perspective, you know, if you're not being seen as retrenching people, it's just early retirement. And it's really rough because, you know, it's at an age where people are going to find it really difficult to get another job. So those have been the most difficult because, you know, sort of between normally people who are in, in a salaried position between 55 and 65, hopefully you've paid down the bond, hopefully you've kicked the kids out the house, and you can actually really start accumulating your funds. But now suddenly you've got to that place and now there's no job. So, it is really, really rough from that perspective. And, it's sort of managing those emotions and stopping knee-jerk reactions and that kind of thing. And so it's basically, look, you could find work, right? And I keep saying it in my blogs and in my newsletters and everything to my clients, is that your best defense against being retrenched or getting put on early retirement is to work for yourself, right? I made that decision when I was 50, so also already fairly long way down the line, and yes, you have to take a few steps back, but it's better to take do that decision when times are good, not when you've been thrown out the door. Here's your copier box and cheers. So that's it. And then it's if your wife isn't working, you send her out to work as well. So it's really, really tough. Make no mistake, because the property market isn't buoyant, so you can't say, well, sell your property and rent somewhere smaller, and even sort of move out and try and rent to someone else. It's really difficult, and you just have to try and have conversations with financial institutions to give you some accommodation until you can come right. But it's that early retrenchment one that is the killer.
I think maybe if I can just step in there as well, Jackie.
Yes.
Two other points that have come to mind around the conversations were really at the kind of height of the market drawdown. So March, April this year, when the market looked like it was in free fall. The conversations around that and keeping people invested were quite difficult. So some of my clients were adamant they wanted out, and some of them didn't phone up. But what it did highlight to many people is what your real risk profile is. So everyone kind of says they're aggressive and they want maximum returns until something like that happens. And that was a real life example, although we seem to be having them, frequently, of what you really can tolerate and how you really feel about losing the value of your money. And unfortunately, some people did cash out at that point, and they've banked those losses, and that's difficult. And it's difficult for the financial advisor then to make a decision around when you get back in, when you get back into the market, because the money has to go back in. So we've had a lot of conversations around that. And then for my younger clients who are paying down debt, I think it was an eye-opener with the decrease in interest rates to see exactly how much you pay in interest, and the savings that were made because of the decline in interest rates. But then the kind of regret of having not tried to pay down bonds earlier, etc., because of the amount that was actually the interest portion versus the capital portion on things like mortgage loans. So I think that it's been a little bit of a baptism of fire for people with finances, but they really have, the ones who've applied their mind have got to see how things really work. And then you can start having the real conversations around how we really structure your portfolio, why diversification absolutely matters and why you need it in the portfolio, why you should pay down that. It's not just lip service anymore. They live the reality. And I think that certainly in my practice, that has helped me have those conversations around this time.
And of course, a big lump sum, more than 3 months probably. Dawn,
Yes.
What do you think? What sort of minimum lump sum should you have now? Because the stock advice is 3 months of salary equivalent.
Yeah, I think it's more, obviously it's more than that. I think COVID has shown us that 3 months is just not enough anymore. That and the thing is, with an emergency fund, it doesn't have to sit doing nothing. You can still get a basic interest rate out of it. You can even sort of put it on into something that gives you a little bit more. But I would say sort of, if you're an entrepreneur, I'd say a year, frankly.
Wow.
I think especially if you're running your own business and that kind of thing, you've got people's salary in that, because obviously if you're an entrepreneur, and something like COVID happens or lockdown happens and that kind of thing, we don't have you know, furloughs and things like that. You know, as an entrepreneur, you're going to have to either pay your staff or you're going to have to pay them off one way or another. And the first salary to go is yours. So, you know, as an entrepreneur, you know, I think there's a whole, what I found quite interesting is that there's a whole set of risks and attitudes in that around entrepreneurs and investors, who entrepreneurs are inclined to invest everything into the company. And so when a hard time like this hits, they get hit actually even harder, because they haven't got, you know, RAs that they could maybe retire from, and investment. You know, they've just been plowing back every cent into the company, and now, yeah, they've now got to try and stop that company folding one way or another. Yeah.
So the first question is, oh, sorry.
Go ahead, Jackie.
So Rudy wants to know more about how do you pay financial advisors? So obviously it's difficult if you're cash strapped and you think, should I have a financial advisor? But that could be the best money you've spent. But we also know that there are some charlatans out there. And Rudy wants to know, how do the fees work, and what is considered an excessive fee, and what's the best way to structure your arrangement with a financial advisor? Candice, what's your view on that?
Well, I can tell you how our practice works, and I hear his concerns. There are good and bad financial advisors, like there are good and bad doctors, good and bad teachers, and unfortunately, because you know it's such a specialized field of knowledge, people often don't know whether they are with a good or a bad financial advisor. So I take that. The way that our practice works is you know, once we've agreed to draw up an investment plan, an overview, a recommendation, we charge for that on an hourly basis, and depending on how complicated it is, you know, that can be between 1 or, you know, probably max 5 hours. And then we take an ongoing advice fee, and in our practice it's kind of the upper end is 0.5%. I know that financial advisors can charge up to, is it 3 or 5% upfront, Dawn, and then a 1% ongoing?
Yeah, 3% upfront, 1.5% ongoing. Yeah, if they take an upfront fee, they can only take 0.5%, but if they don't take an upfront fee, they can take as much as 1.5%.
So yeah, so there's a range of fees that people pay, and they take that on the assets that are under advice. You can also go to a financial advisor and just say, look, I want a consultation, and then, you know, go away and sort of implement on your own if the financial advisor works like that. I think the best thing for Rudy to do is to approach financial advisors and ask them how they work, and also have a conversation around how their practice works. And you know, in talking to them, he'll get some comfort as to whether there's a resonance or not, because not everybody, you know, every financial advisor is everyone's client, and vice versa. So I think it does involve a couple of phone calls, and until you find someone that you're comfortable with and you feel like you can trust with your money. And that's important from the client's point of view. That is very important, that you feel like you can trust the advisor.
Yet we often trust people, and yeah, sorry, Dawn, continue.
Yeah, you know, the only thing, you know, we in the industry we talk about fee for plan, which is a little bit what Candice does, although she also takes assets under management. You know, so there's the fee for plan, and then there's the assets under management. The fee for plan is when you go to a financial advisor and you say, draw me up a plan and I'll implement it. And you know, and this is talked about often on webinars and that kind of thing, and often get investors coming to me and say, oh, you know, they want a fee for plan. Now, you know, this is my thinking on this has evolved over a period of time, and also speaking to other financial advisors who only do fee for plan, pure fee for plan, no assets under management at all, not a sort of hybrid scenario like Candice does. My only problem with fee for plan is that plan will be perfectly right on the day that you submit it to the client. And every day that goes past after that, it becomes wrong and more wrong. And after a year, it is completely wrong. And it actually then sets up both you and the client to fail, because they'll come back to you in a year's time when they've decided to implement it. They said, I implemented it and it's rubbish. And you say, well, you know, so with my approach to it is that it has to be almost on a retainer system, and that retainer is the easiest way to do that is assets under management, so that you get the ongoing advice in terms of, right, you need to change it to this, you need to increase your emergency fund, you need to put more offshore, less offshore, you need to, you know, retire from your funds, not retire from your funds, you know, all the, you need to do, this is interest rates have changed, so you need to change your portfolio like this, as and when, you know, that kind of thing happens, as opposed to doing the plan and tap on the back and get all the tax and everything right, and then it just changes. It just, I've got to a stage where I just won't do it.
Sorry, I just want to add in there, that's not my preference. This, I completely agree with you, Dawn. As the client walks out the door and they don't implement, that plan becomes more and more incorrect for the client. But I think that maybe just to add to the question, it's also the kind of stuff that you can't charge for is unseen. The decisions that you stop clients making that might lose them money, the fact that you keep them invested through the whole COVID drawdown, is value add, which is kind of doesn't necessarily come out in the numbers. It's the tax that you save. It's the kind of knee jerks and the panic that you tend to kind of damp down. That is what Dawn's talking about when you have an ongoing relationship with the client on a daily basis and you're monitoring these portfolios. And you're getting those newsletters that Dawn talks about, and you're getting the input from your advisor, and actually you have someone to phone at that time and go, I'm panicking, I want to do this, and somebody can talk you through it. So those are the kind of the soft things that you don't realize that you're paying for, that you have this person on tap. So yes, Dawn, I'm with you. Rather have assets under management than fee for plan.
You know, I mean, when we're talking about fees, you know, 0.5 percentage point or 1 percentage point, and you can say, right, you know, 1% on, you know, on $1 million is 10,000 Rand a year, and all the rest of it. But you need to put that also in perspective, is that have a look at 1% in terms of what it means in the market. Have a look and see how often the JSE will in one day increase or drop 1% in one day, right? And never mind the sort of 20-30% that happened, you know, that sort of very sharp flash crash that happened over, you know, the COVID period, the beginning of lockdowns and that. You know, it's putting it in perspective that, you know, okay, you might have to pay me 0.5 percentage point per annum, but, you know, what about me stopping you dropping 30%? And, you know, selling at the bottom, and then me trying to get you, you know, to buy again, and then you suddenly decided to at the top of the market again. It's, you know, look, we're both financial advisors. This is how we earn our living. But, you know, one of the things about financial advice, unlike, you know, salary things, is our salaries on full display. It's out there in the open. There's no secrets. You can see exactly how much we get paid down to the cent.
Thank you very much for that very thorough response. Alexandra would like to know, emerging markets are projected to do well in the next 10 years. Will South Africa benefit from this? So this picks up on your idea that you can't assume that you're going to get the best bet if you take all your money offshore. Candice, what's your view on having some emerging market exposure if you are South African?
Well, remember, if you are South African, you have 100% emerging market exposure to begin with. So you need to kind of, you know, factor that into your portfolio. I think we are seeing a global shift away from developed markets towards emerging markets, and things like China and Korea fall into those brackets. But then so do places like Brazil and Russia. You know, India is also looking to be one of those superpowers. So yes, this is again where diversification comes from. And if you have a diversified global portfolio, you'll have a lot of the names that are housed in those emerging markets in your portfolios. If you have your pension fund invested in South Africa, you have a lot of exposure to an emerging market. How South Africa benefits, though, and particularly our stock market and the Rand, is, and we've seen it now, we've seen it since the US elections, what is called the risk on trade is back on. So people are feeling good about stock markets. You know, vaccines are all around the corner. Biden's in office. We're going to get a more measured and temperate US government. People are feeling like they are okay to take risk, and so they come to emerging markets, particularly South Africa, to look for our yield. So despite the fact that we've had this precipitous drop off in interest rates, our yields are still high when you look at it relative to other countries, and particularly places like the UK and the US, where, as Dawn pointed out, there is no yield there. There are no interest rates. And so people are buying, portfolio flows would flow into South Africa, and that's causing the rand at the moment to strengthen on the back of the fact that we have a lot of commodity shares. So our GDP doesn't depend entirely on resources anymore, but we do have good listed commodity companies. So that is the way in which emerging markets benefit as the world kind of moves out of the impact of COVID and economies start firing up again. Everything does depend pretty much on these vaccines, how fast they are rolled out, who is able to take them, herd immunity, that whole discussion as to whether this risk on trade remains. So it's a very volatile thing that we're seeing, and also which countries benefit. So Dawn did speak about us punching above our weight in terms of Africa, but in terms of emerging markets, we do too, because our finances are not in good shape, but we have a very high functioning financial system, and people, international portfolio flows want to be here. So it will benefit us. The next question would be, do you put 100% of your money in emerging markets? No, you don't do that. Once again, you look at a diversified portfolio. You look at emerging markets where you can trust the legislation, you can trust the regulation, the companies and the industries that are represented in those emerging markets are the ones that you actually want to hold. So there's never one answer to any of these. The other reason why emerging markets are looking so attractive is they're coming off a low base. So we've seen the American markets really rally. The Dow keeps hitting new highs. The S&P does. We've seen the FANG stocks holding up most of the global indices, but emerging markets have been ignored in that. And now people are looking around and going, industry's picking up, consumers are starting to spend. Where does all of that input come from? A lot of it comes from emerging markets. So that's why emerging markets are starting to look attractive once again.
It seems astonishing that China is still considered an emerging market when you look at the projections for how its economy is going to dramatically overtake the US. Dawn, how do you advise your clients on emerging markets exposure?
I think diversification is the absolute key. There are some ETFs out there that are global and kind of water down some of the the big economies. They water down a little bit, maybe China water down the American influence, and so they're much more global and will have exposure to several dozen different countries, not just a handful of them. And one of the ways to sort of handle that offshore, as opposed to sort of until such time as you've got a critical mass that you can diversify it into single shares. But even then, to get an exposure to an idea, and certainly if you have a sort of a global ETF but have sort of satellites around it that are, for example, maybe a bit more China, maybe some Taiwan, maybe some Korea. We've even put some Japan in there. India comes into consideration. Then you start looking a little bit at South America too, and those will switch on and off. You'll sell in and out of them. You've got that sort of global diversification in the core, but just add sort of sweeteners around the edge as it's mostly emerging markets sort of come in and out. We don't have a lot right now in the UK, until they sort out their Brexit nonsense. Sorry, Jackie. But and Europe obviously, and until they sort of get that. Look, that COVID is starting to come off and getting under control in that, but it's a bit of a sort of up and down situation at the moment, because obviously with lockdowns, which the Americans won't do, does impact their manufacturing and industry and those sort of things. So it's a matter of getting as much diversity as you can. Don't go and just buy Tesla stock or go and buy Amazon stock or something like that. Find a platform that will give you broad exposure to loads and loads of shares and commodities and ETFs and whatever else it is, so that you can actually build this. Or probably, unless you know what you're doing, get somebody to help you. Actually give away 0.5% and get somebody to help you.
So Amazon's an interesting one because it is in the BizNews share portfolio, so has helped propel it considerably. So before we move on to the next question, Rowan has an observation, and perhaps you could just elaborate, Candice, on what he means and how people can invest in this. Rowan says there's been a lot of discussion on the FANGs, and that people are aggressively peddling funds with the FANGs in them. But people might be interested to know that the South African government's R2048, measured in US dollars, has outperformed the NASDAQ. I'm not sure whether you call it the R2048, but what are your views on what Rowan is saying here?
You know, whenever an industry or a stock or a fund runs, everyone has a lot to comment on, and the people who were in it at the time are feeling very smug, and the people who weren't in it at the time either criticize it or they jump in and they do the Me Too thing.
Yeah.
It's a no-brainer that the tech stocks ran during lockdown for all the reasons that we know. I don't need to go into them. Cast your mind back to 2000 when we had the dot-com boom and collapse, when tech stocks were the darlings at the kind of inception of tech, when the companies had no earnings, they had no business model, money was being thrown at them, people were throwing their investments at, and they all ended up with in disappointment. There are a handful of companies that have done well and will continue to do well, and I think that structurally growth, which are these tech companies, are spurning a new industry, and it's not just tech, it's the way that we actually live, interact, play. It's everything that we do. Those companies still have earnings and they still have a value, and at the moment they are probably very highly valued or overvalued. So this comes back to, and I know it's boring and you hear it all the time, it comes back to this diversification thing. Have some of that in your portfolio. You know, if Dawn and I, if we could sit here and say we know what's going on in the next month, our clients could have said, well, why weren't our portfolios 100% in Tesla? Well, they weren't, because there were a whole bunch of risks there and we didn't know it was going to run like that. And we would never have put our clients into one stock. We would have diversified. So my clients very much do have what is going on in the NASDAQ. What is going on in the NASDAQ is also going on in the MSCI, which is a broad-based diversified ETF that covers 26 countries, which is what Dawn's talking about. And the top 10% are those FANG stocks. The difference is that the weightings are a lot smaller than what's going on in the NASDAQ. So you can own Apple in the MSCI and it's about 2%. In the NASDAQ, it's about 10%, which is why the one runs more than the other. But the MSCI is a great portfolio just to hold if you only want to hold one security. So yes, there's always going to be something that outperforms something else. The point is that you want to hold a little bit of it because you probably won't be holding all of it at one time. Long
Dawn,
answer.
anything to add to that?
No, Candice and I obviously, singing off the same song sheet. We, it's prudent advice, and I mean, I often get, a phone call and that, and it's, and I never say this to my client, but I'm sure I can say it here and people won't take offense, is that you have to moderate your greed. It's and forget about FOMO and all the rest of it. The thing is, it is what it is. And if you've got excess money, go and do what you like. Go to Monte Casino and put it all on black. Buy Tesla, do what you like. It doesn't matter. If you can afford to lose it all, then it's a completely different conversation. But if this is your, building up to your life savings, or is your life savings that you're going to have to live on, you need to be prudent. You need to diversify. You need to switch off. I mean, there's just so much noise in this, and it's got louder. Let's face it. I mean, I think I've told you, Jackie, I've got to the extent where I'm not on Facebook anymore. I'm not on Twitter anymore. I just can't stand the bickering, especially in America. I mean, they just need to put a fence around America and let them get on with it or something. It's just, and calling people names and threatening, take him out and shoot him and hang him, and it's just become so toxic, and you can't separate politics and economics. I mean, that's why we've had what Trump thinks it's a Trump bump, but it's actually a Biden bump in the last month and that. But you have to switch off all that hype and noise, and we have them here. We have them here. Who sort of get on a bandwagon and have got really loud voices and really hammer it in. But you need to sort of take a step back and, yeah.
So you're not going for
Yeah.
one of those US passports yet?
What? Yes, not. Yeah,
So,
you know, yeah. I mean, I've been to America lots of times, and I've got some really good friends in America, and they're lovely people. They aren't Americans; they're actually what you call immigrants. They're legal immigrants, but yeah, you know. But it's a lovely place. But yeah, you know,
so,
they need to get this. You know,
so Tracy is immigrating. I have no idea where she's going to, but she says if she leaves her pension fund assets in South Africa and immigrates, how does she handle the exchange rate? Candice, what kind of broad brushstroke guidelines do you give when your client tells you they want to immigrate?
I usually ask for a lot more detail than Tracy's just provided. So yes, where is she going? Is she never coming back? How much of her assets does she want to leave here? Then in an emerging company when we know the currency is going to depreciate. Is she prepared to pay the tax if she wants to liquidate those pension funds or preservation funds if she can, if she has retirement annuities? She can't unless she financially immigrates before March next year, or then waits for 3 years and proves that she has changed tax residency. So there's a whole bunch of questions that you would have to, you know, a discussion that you would have with her. But if she's going and she's never coming back, she needs to consider taking her assets with her.
Dawn, how do you decide which exchange foreign currency to go into from an investment point of view?
Well, you know, that's a really good question, because if somebody's immigrating, then you align the currency with where they're immigrating to. That's easy. But if somebody, you know, you always ask the objective, and I'm sure Candice is, you know, why are you wanting to invest offshore? And then you can make the decision from there in terms of what the currency should be, or in fact whether you should not in fact take it across, but put it into offshore exposure here if that's what offshore, the sort of offshore that they're wanting. But you know, I think something that somebody said to me, you know, 15 years ago, and has held true up till now, as much as I'm a little bit maybe anti-American at the moment, is that never bet against the dollar. You know, yes, it has its ups and downs and this kind of thing, but you know, it's not going anywhere. And it'll depreciate a bit and get softer, and it'll get, you know, these kind of things. But at the end of the day, if you don't know, you know, where to put your money, the dollar's a pretty good bet, you know, unless you want to sort of get into currency trading and then split it across 5 different currencies and this kind of thing. But you know, it's yeah. So most of my clients, if they're not emigrating, the money's in dollars.
Thank you. So Charles sent a question through earlier today. He said he's 72 years old and he wants to stay in South Africa. He has about 4 million rand and it's currently in a money market fund, and he is living and being taxed off the interest. He's not sure whether this amount will be enough for his expenses in the long term, and he thinks he might live to 85. But who knows? You were talking 105 earlier. Dawn, what's your view on this? He's thinking about maximizing overseas investments via a LISP platform. And can either life or living annuities meet these objectives?
You know, I think the one bit of information missing there is how much you're expecting out of this 4 million, right? And you know, from my experience, that could range from 5,000 a month, 30,000 a month. Seriously, you know, obviously, if it's in interest at the moment, he's probably getting around about 15,000 a month from it. So we'll take that as a base that maybe he's comfortable with, maybe he's not. You know, that's the first question. The second thing is that really you then have to say, okay, I've got 4 million and the client wants 15,000 a month, and it needs to be sustainable. Forget about, I think I'm going to die when I'm 85. You don't know, you know, and really very few people know when they're going to live and when they're going to die. You know, you know, my ex-husband said he was going to be dead at 70, you know, or 60, I think. He's gone 60, I think
Still
it is,
around.
but he's gone past that, you know. So you've got to sort of say, right, this income needs to be sustained, because I could live to 100. You know, it is possible to live to 100, even maybe beyond that 105. And the one thing I say to my clients because that means then you have to take less, right? Because you have to take some of it that you live on, but you have to put it back because we've got inflation and the money has to continue to grow so that your income can grow. So instead of taking down, maybe 6% or 5% and that kind of thing, we're probably down to sort of 4 and 4.5%. But I never want to sit in front of a client. I've done their planning. He's now 72. When he's 85, and I'm not going to say how old I'll be, but I might be able to drive there. I might have to take an Uber. And say, that discussion we had 15 years ago where I told you when you turned 85, your money's gone. Well, guess what? That happens next month. I never want to be in that situation I'd rather not have them as a client if they insist on drawing it down and it running out at a certain time. I mean, I know it's changed and that kind of thing, but I want my clients' money to be sustainable for the whole of their life, and it doesn't matter when they die.
Thank you, Candice.
And so, in his case, yeah.
Sorry, Dawn.
So in his case, I would build an income block to supply whatever income it is. If it's 15,000, there's not going to be excess to do offshore. And forget about living annuities and this kind of thing. You'd have to put it in RN, then living annuity. You can put it on a list platform. You can put it on any kind of platform, get it to produce an income. But you would need an income block, and that would mean probably conservative. Would be maybe some government bonds, maybe corporate bonds, those kind of things to produce an income. But there's not going to be a hell of a lot left over unless he's wanting to take maybe 5,000 or 6,000 a month, or 10,000 even. You could maybe have 500,000 that you could play around with overseas.
Candice, do you have anything to add to that? I know you've got some similar views to Dawn, but you might have something different.
So what I would just add to that is the question specifically asked, should I be looking at living annuities? I'm assuming that money is not in any sort of pension funding vehicle. So the right thing to do is not to put it in a living annuity, because the money coming out of a living annuity is taxed as income. Whereas the money coming off of your investment is taxed slightly differently and sometimes can be taxed at a lot lower rate. So I would add that to it as well. And then if he really is sort of cash strapped and that 4 million isn't going to get him where he needs to go, he maybe wants to look at putting some of it into a guaranteed annuity. But that, someone would have to do those calculations for him, and you'd need a lot more information from this particular client before you could even start advising him as to where to put that money. But once again, just going offshore as this bullet for a badly planned retirement isn't going to work.
Thank you. So we've got time for 2 more questions. The second last question is from Malcolm. He says, how does he deal with the risk of depending on a single financial advisor versus a financial advisory business? What are your thoughts? So I guess this goes back to, how do you choose the right financial advisor? Do you want to go for Dawn? You work on your own, don't you?
Yes, I do. I think it boils down to what Candice was saying, is trust. You've got to find an individual, and it doesn't matter whether it's an individual in his own practice or an individual in a larger practice, that you trust the level of advice that you're getting from them. Obviously, then it runs into a little bit of a problem if they leave that practice and go to another practice. Often what happens in that case, that you will get clients moving with the advisor because they've bought into the trust of a certain advisor rather than a practice. Obviously in my case, I have a succession plan, and it's getting to the stage where I'm starting to introduce my successor, much younger, much better looking male, to my clients, so that they know that they've got a certain level of continuity. But it's going to boil down to finding somebody that you can gel with, somebody who talks on your level, somebody, when they explain something, you can actually understand what they're trying to say, and that you can trust that they're giving you that advice with your own interests in and not theirs in place. So you know me, I'm not a huge fan of what's called a tide broker, because they're limited in what they can advise you to put it into. They're limited. They have to put you into the products belonging to that particular company, and that might not be the best way to go. But if you go with an independent advisor, it's going to depend on the personality, I think. Candice?
Thank you. Yeah, Candice, do you work with somebody at PR Financial Services?
Yes, I have two partners at PR Financial Services, Pauline and Barbara. But just to add to what Dawn has said is that clients should rest assured that a well-implemented plan doesn't expire the day after your advisor disappears. So you do have time to find another one should you want to, and should you not want to stay with the successor, or for whatever reason. You know, the plan does have longevity and it endures. And the other thing that I think that maybe people are not aware of is that we're all not working in a vacuum. Advisors are very well connected with each other. We're very plugged into the industry. We are on a constant learning curve, education curve with each other and the industry. You know, if we have really sticky client issues in our practice, I talk to advisors that are not in my practice, and I go, you know, I've got a client X with this issue, how would you handle it? Because there's not one way to deal with it. So I think that as long as you have an understanding that your advisor is kind of at the forefront of what is going on in the industry and involved in it, you can rest assured that it doesn't matter whether a single practitioner or part of an enormous setup, you're getting good advice. You really will be. And it comes down to that trust and resonance thing that we spoke about.
Thank you. And then the last question, Ian wants to know about the different ETFs and the difference between a feeder fund and an ETF. Candice, perhaps you could just briefly take us through, you know, what a feeder fund is and when you should invest in it.
Okay, so the feeder fund and the ETF story has come up in the same conversation as the Reg 28 issue that we spoke about initially, but I'll put that aside for a moment. So your feeder funds are your funds where you can invest offshore with rands. So you're not going through your SARB clearance. You're not taking your 1 million offshore or getting tax clearance for 10 million and taking that physically offshore and investing it offshore. You're investing it in rands locally. The asset manager is taking the money offshore and investing it offshore, but you are getting the returns back in rands and you need to disinvest it back in South Africa. So that's a feeder fund. It's feeding into an offshore fund. ETFs can work similarly. So some of them are local ETFs. ETFs are exchange traded funds. They're actually collective investment schemes that are listed on the JSE. So they act and look and walk and talk like shares. They can invest in, so normally what they do is they track an index. They can track the JSE or the top 40 or the Indy or the Resi. But I think where this question is going is looking at the feeder funds that some of the ETFs invest in. So for example, the Satrix suite of global funds invests into the BlackRock iShare ETFs and allows you as a South African to invest in a BlackRock iShares ETF through a Satrix ETF on the JSE. And what that actually is doing is giving you economies of scale with regards fees. It's, if you want to get really technical, it's making sure that the tracking error of the ETF is as small as it can be. The tracking error is how closely your ETF tracks that underlying index. And if you think of the magnitude of a company like a BlackRock or a Vanguard, they can track the indices very closely. I think where this question has come from is that there seems to be a little bit of a conversation around whether an ETF that invests in a feeder fund versus an ETF that is physically tracked from South Africa is better or worse. And I would argue they're the same thing. If they're both tracking the MSCI Global Index, or they're both tracking the NASDAQ, or they're both tracking the S&P, that is what they're supposed to be doing, and that is what they're doing. So the feeder funds are a way of investing offshore without physically taking your money offshore, whether it's through an ETF or a unit trust.
Ian has another part to this question. He says that the info write-up on the feeder fund states that the fund doesn't make distributions. So how do you actually get your return from a feeder fund, and how do you get your return from an ETF? Dawn?
Often what happens, well, ETFs will pay out, I think it's twice a year. They will accumulate like dividends and that kind of thing. What the feeder funds are inclined to do is mop the you know, dividends or whatever yield that comes in back.
I think we've lost Dawn. Candice, would you like to pick up on that final piece of the question?
Yeah, so you get funds that are called roll-up funds. So the difference is is Dawn coming back? Dawn, you broke up there. Do you want to repeat that?
Yeah, I think my connection yeah, it's decided Fridays come early. Yeah, it's often feeder funds and ETFs will use those distributions to pay fees first before mopping them back up into the fund, or paying it out in the case of ETFs. So in some cases with some feeder funds, that offshore feeder funds, those distributions are almost wiped out by fees.
Okay, so they could be quite costly. Well, thank you very much. That's before we go, Candice, would you like to share your top tips for what should we do with our finances next year? How are we going to all make sure that our personal finances are in better shape than they have been in 2020?
We're going to have to work harder and spend less, Jackie. No, without being facetious, I think that what we've learned through 2020 is that we need to apply our minds to our finances as much to everything else. That emergency fund has to be intact. And if you did have this dry run, looking at an unplanned retirement that wasn't well funded, take the time to really put the finances in place. If you're not speaking to a financial advisor, speak to one. If you want to do it yourself, immerse yourself in the knowledge, but don't ignore it. It's not something that goes away, and it's not something that fixes itself on its own.
Thank you. And Dawn, what are your top tips for us before as we head off to our holiday and start thinking about how we're going to change the way we run our finances?
You know, the one thing that I started to do, I think 10 years ago, that made a huge difference to my practice and my own personal wealth, and that was I actually put together not a resolution, but a plan every year, my own financial plan. That you know, I used to be in marketing, so it's actually, and I've got an MBA, so it's actually a proper business plan, but it's on a personal basis. And that actually made a huge difference to my focus when it came to my practice and how I was going to build it and what I was going to do. You know, spend the time to think about not just, you know, oh, I'm going to earn more money or whatever it is, but how you're going to do it, and what action plan and what qualifications you need, and all of those kind of things, to actually put a personal marketing plan together. You know, and you know, instead of a resolution, I have one word for the year. Right. Obviously, last year's word got kind of like lost, I think, like most things that do in 2020. But, you know, if you can sort of put this plan together and have one word that sums up what you're going to do, you know, whether it's, you know, to grow or to preserve or to invent or to create, whatever it is for that year, to have a kind of a theme that goes through your personal plan. But that is the one recommendation I would make to people, is actually, you know, spend a bit of time and put together a plan and file it and refer to it from time to time.
Can you share what your word is for this year, or haven't you decided yet?
I haven't really decided yet. You know, it depends on it's probably growth. I've going to be expanding my horizons quite substantially. So I think probably growth.
Okay, well, thank you very much. Thank you, Dawn and Candice, for joining us today. And thank you to everybody who attended the webinar. If you have any questions or want to get in touch with Dawn or Candice and can't find their details, here are my details, and you just send me an email and I'll forward your details to them. So thank you very much, and I hope you all have a good holiday, and we'll see you next year.
You too. You
Thank
too,
you.
Jackie.
Bye. Bye.
Bye.
Thanks, Jackie.
Bye, Candice.
Bye.
Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.